Okay, she introduced all of you to the audience, so I'm just gonna skip the introduction. But we have, this is for me like most the fascinating panel because we have the current central banker from Bank of Canada. We have ex-central banker, now works as a CTO of IBM blockchain. And you know, all-time favorite director of research at R3 that builds distributed ledger technology, sometimes for central banks and commercial banks, and Gina, academics. I always love to bring academics to the economy. So we're going to discuss on the topic of central bank digital currency, and I'm going to give you the context of what central bank digital currencies are. We're going to call it CBDC. Last year, Deconomy, we had the same panel with different people, but this time we really have the current central bankers, so that'll be interesting. So the context of the CBDC today is retail CBDC. Last year we talked about wholesale, the RTGS, the central bank digital sort of reserve between the commercial banks. But now we're going to talk about in the context of an individual, like the average Joe, holding a monetary value issued by the central bank directly. So we're going to talk 4 criteria of central bank digital currency, which are motivations of, meaning that why do you issue central bank digital currency, and consequences, what's the consequences of issuing digital currency, and adoption, how do you get the adoption, and design, the economical design or technical design of central bank digital currency. So let's start with the motivation of CBDC. So why should central banks should issue retail digital currency?
Well, I guess I can start. And typically, for a central banker, I have to start with a disclaimer. Most of my remarks will be mostly questions, but hopefully with my questions, you get a sense of how to think about the issues. But my views are my alone and not the ones from the central bank, the Bank of Canada. So the way we think at the Bank of Canada is that there's 3 broad areas of motivation. One is to improve monetary policy transmission and implementation. So that would be one motivation to issue CBDC. Another one would be to improve competitiveness in the market for payments. If the central bank were to issue its own digital currency, could improve the market for payments. Also to improve the efficiency in payment systems. And fourth, there are a variety of other reasons which are not usually in the remit of central banks, but for example, it could be increasing financial participation, financial inclusion. Other motivations could be to combat crime. Those are kind of far from central banks' motivations, but they're still discussed as one of the motivations for issuing CBDC.
I think you just hit all of them that I could possibly think of. So I don't have anything to add to his questions. I think each of those points are slightly different, and I think they differ, whether or not they are in the purview of a central bank depends on each individual country too, which I think is sometimes an overlooked point, where a retail CBDC might work for one country and be a terrible idea in another country. This was somewhat raised in the keynote, in the opening remarks yesterday, where it could work. Like maybe it doesn't work in the US, maybe it makes no sense, but it might make sense in Kenya.
I think it's interesting that we're walking back the financial inclusion argument. Over the past couple of years, I've heard financial inclusion being one of the main reasons why, or one of the reasons discussed as to why a central bank would want to issue a digital currency, whether it's a cryptographic currency, whether it's whether transactions are signed by private keys, or whether it's a more usual kind of account-based system. But now I'm hearing financial inclusion less and less. Is that because perhaps central banks have realized that by removing cash or replacing cash with a technological solution, we're actually excluding and marginalizing some parts of society, those who either are uncomfortable to use technology or unable to? Is that one of the reasons why?
I guess my sense is that for developed countries, which typically they're well served in their means of payments, the question of financial inclusion is not being kind of top of the list. But there's an aspect which you could fit into financial inclusion, which is resiliency. Is occasions in which, say, the network has fallen, or there's been an attack, a cyber attack on the big banks, you could call that resilience. And the central bank, if it were to have its own system and its own digital currency, it could provide like a backup system the way cash is today, right?
So a digital backup system to be resilient to a cyber attack.
Right.
It sounds like a contradiction.
No, because...
Isn't physical cash the ultimate disaster recovery tool?
Correct. But I mean, if it were a separate system from the systems of commercial banks, it would be a resilient system. Yeah.
So I think back to the resiliency point, it's important to note that what's the main use case for a digital currency in the first place, right? Digital money. It's for remote payments. So when you transact online, that's typically when you need to make payment, and then cash is unusable in that context at all, right?
Yeah.
So unless you have some form of account, unless you have a credit card or some money that sits somewhere else, there's very little recourse for you to make that transaction. So this isn't just a question of financial inclusion for people who are who have less income or who live in less developed countries. This is really a concrete problem for people, the younger people who live in many of our countries, right? They don't have access to secure ways of paying online. They have to go to their parents or someone else to do that for them. So in the case of a resiliency issue, it might be that some central banks are uncomfortable with all the transactional infrastructure being driven just by market forces that don't take into account necessarily the needs of the public that they serve or are meant to serve. So this could be the fact that if you have a monopoly on all transactions that are online, then you could charge monopolistic rents, right? Versus a central bank that might provide cash today at a subsidized rate, effectively.
Right.
And I think there's another aspect to financial inclusion that can get overlooked, because I think the standard discussion a few years ago in this space was, I'm adding another network through which people can pay. And what we're seeing in other countries where you're seeing this growth of e-money is that that's not necessarily a definite good. So in Sweden, you see the removal of ATMs and cash-based acceptance. In Kenya, you see the growth. So if you are somebody who can't use the mobile systems, in Kenya, it's the same story as it always has been, so you're not excluded. But in Sweden, if the cash ATMs are going away, you're seeing fewer cash, now you're being excluded, and then you're worse off. Right? So the inclusion is not just, I'm adding a new system, it's I might be removing cash at the same time. There is this cost and benefit trade-off.
Yeah, I mean, for developed economies, the issue of inclusion is not only related to income, but it could be also related to geographic considerations. For example, the north of Canada, and that's the Arctic, there's basically low connectivity. So maybe if there's no cash and there's no connectivity, they will have a very difficult ways of transacting, right? So there's a role for public policy to try to look at potentially subsidizing a means of payment to serve a wider range of use cases.
Right, so in that case, is the subsidy not really on the cash substitute itself, but really on the networking and all the infrastructure that comes along with that, right? That you're providing really a means to transact across long distances rather than, this is about inclusion in the ability to transact online rather than inclusion in a currency system.
Correct. I mean, the public objective of central bank typically is to provide a safe and efficient payment systems that usually relates to the wholesale systems. And on the retail side, that tends to be banknotes, which are trusted and durable and hard to counterfeit. So if cash is going out of circulation, out of choice of people, then maybe there's a role for central banks to look into stepping into that role, providing a digital alternative to cash, for example.
So what's to stop a central bank from saying, okay, so I have an issue with cash supply to really hard to reach regions. Mm-hmm. And I have another issue, which is that banknotes tend to wear out and get dirty and not work so well right, in transactions, because I don't trust if this thing is genuine because it's so worn out. Now, you could move to multiple technologies beyond the purely app-based type things or blockchain-based solutions. You could have a indestructible bank token. So literally
physical token,
a
you
piece of not metal, but something that's really indestructible. And then that would be distributed in some secure way to these regions, and then allow for circulation to take place in an indefinite self-circulating way.
Right.
Conceivably, that could happen.
Yeah, no, I see all these are kind of the questions that central banks are weighing. And as we've been discussing through many forums with central bankers, the particular motivation will depend on the particular use cases that the central bank needs to target. For example, Sweden is a case in which they're being reactive to the question of what's going to happen if cash goes out of circulation, because there are better alternatives. So in the case of, and I don't want to speak on behalf of the Riksbank, but they seem to be reacting to the case of cash going out of circulation much faster than what they would have expected. Thankfully, that's not the case in Canada, in which cash is still approximately 3% of nominal GDP, and it's been stable for quite a while. So we don't feel the pressure that we need to issue because cash is being out of circulation, but we have a kind of a more expansive view of.
But it does pose the question, right? So if the cash, the cash base is growing because it's growing. I mean, it's
Nominally.
a constant proportion of GDP,
Correct.
which is growing. Right?
Yeah.
So the thing is that it supports the same number of, theoretically, the same size of transactions per
Well,
unit of
that's
cash.
interesting, is because the composition of nodes has been changing radically.
Right.
So
Okay.
although in nominal terms, the total value of banknotes in circulation has been steady at 3% of GDP, typically larger denomination notes are becoming more important in that composition. So that's consistent with the data that shows us that now cash is not being used at point of sale. That the use of cash at point of sale is falling very rapidly, and it's been substituted with credit cards, debit cards. So that's probably then this points to the fact that people are using cash as store value, not as a means of payment.
Yeah.
So
Okay.
is it a problem with negative interest rates, or why are they moving into cash as a store value?
That's the question, right? So we're talking about motivation, and we're now talking about the consequences of having the CBDC, meaning that the central banks issued currency within the hands of the individual holder, which is very different from the current system. Current system is credit-based, it's commercial bank issue currency. That's what we hold. So what are the consequences, economic consequences? What's the economic outcome of having the CBDC, and also the technical or privacy, I should say.
Sure. I think before you talk about the outcomes, I think you have to really talk about defining this thing, right? So what should it have an interest rate associated? If so, who controls it? Clearly, the central bank. But should it be zero all the time, or should it have a positive? Should the lower bound be zero, or could it go negative? Could the central banks reach into your pocket and remove money from your pocket in a way that they can't do with physical cash? Should identity travel with this money? One of the asset tests, and this wasn't me, one of my colleagues came up with this thought experiment. Currently, a child can give money to a homeless beggar in the street with physical cash. Should something like that be the asset test for whether a digital version of cash is successful or not? Could that same scenario happen? So a miner, that means a young person, not a Bitcoin miner. Can a young person who's under 18 and therefore maybe can't open a bank account or whatever, depending on the rules of the country, can they transfer money to someone without an address? Right, because you can with cash, whether that's a good thing or a bad thing. So it's something like that, perhaps the acid test for the design of this thing, and that touches on a lot of things like privacy, financial, personal privacy.
Yeah, I think
Gina?
there's a very understudied or not well understood way of how this retail gets into circulation, right? So retail is consumer based. Do you have it, it's just a glorified, essentially, payment system? Do you have an account-based system with either the central bank or with private banks? Does this coexist beside physical cash, or do you end physical cash? So the zero lower bound is typically in existence just because you can't, if you try to drive your interest rates, for example, on your savings account in your bank below zero, people can take out their money and keep it in cash by the bedside. But if you stop allowing physical cash to circulate by their side, right, then you don't have the concern about the negative interest rate anymore. People can't evade it anymore. Right, so think about the bank penalizing you if you don't spend your money. That becomes a concern. And what implications does that have for inequality? How do you implement that? How do you think about the welfare effects of that? That's not a trivial matter. And if you do go the CBDC route, that becomes a non-philosophical matter as well.
Yeah, this is where there's a relationship between the motivation, the design, and the implications are intertwined. So it's very hard to separate the motivations from the design, because depending on what you want to achieve, then you would design it in a certain way. As Anthony mentioned, is the question about, is it an interest-paying CBDC or not? Well, typically we think interest-paying, but you could also have negative interest rates, right? So, and our research has shown that when you have a CBDC that can pay positive or negative interest rate, you have much more power for implementing monetary policy. So in theory, it should be welfare improving, so better for everyone if the central bank were to issue a CBDC that can pay interest, or positive or negative. But indeed, like, how would the people feel of being taking money out of their pockets?
We need some Bitcoiners on this panel to really kind of spice it up and argue against it.
But there's also the account-based system in terms of privacy, right? Never mind a miner paying somebody. Do I want the government to be able to see the entirety of my financial transactions? Right? That can be good or that can be bad, depending on the government. Right?
And if a government shifts from being a good government to a bad government.
Exactly.
So, I mean, that's also the question of implementation, right? If you want to implement a privacy protecting system by design, whether you can truly design that to be resistant to a state-sponsored actor that has infinite resources theoretically to beat that system again, that might be, have been designed by a different branch of that same government. That's debatable, right? Again, you might have the motivation, the right motivation, you might have the right design, but the implementation could fall short. So in reality, this is a complex three-legged problem. Right?
Well, and then you also somehow get into this question of government stability, right? So let's think about Venezuela, and I'm not going to call that a CBDC. I'm just going to sort of say that the thing called the petro exists, and part of the government thinks it's okay, and it exists as a form of payment. Another part completely disavows it, right? So they've got tension within a government even, and what does that mean if that system gets shut off, if the government is overthrown? Right now you have nothing to show.
Yeah, on the point of privacy and anonymity, it's, I think, a deeper question that hasn't received enough attention, at least in academic circles, is what's the role of government, or in particular the central bank, in providing some form of privacy? Is it or isn't it the role of the central bank to provide that? And if you think about cash, cash provides anonymity, but incidentally because of its form. It was never designed for that purpose, right? But we kind of, maybe we can think that people have become used to that feature of cash, so they might want the new future form of...
How do you put a value on it? What's the value of privacy and anonymity for cash payment? I mean, in some countries, they're banning payments over a certain size in cash.
Right,
I think
right.
France, I don't know.
I mean, there might be transactions that might be completely legal but embarrassing to you for someone to know. And you might put a value in keeping that private to yourself, so that's one aspect. But there are other externality effects from the fact that if you don't have privacy in a transaction, there might be a nefarious actor that takes your information for bad purposes, right? Maybe they start collecting your patterns of trade and they can extort yourself. This is the question of identity theft.
And even if it's a good government, governments are not immune to being hacked
As well,
by
yeah.
either other governments or
Right,
other
right.
hackers who can then make use of this, this information.
Right,
Correct.
but I think let's take a step back and say that this is a point in time statement, right? You know, it might be that yes, today we are uncomfortable with having all that information out there because you might have identity theft and so on, but because once that problem exists, once it's being posed by the system that we have, say, put in operation, there will be people who will come along to try to solve that pain point with alternative reactive tools or new, you know, overlays and so on, right? So it's just that at this point we don't know those solutions yet because the problem is not well posed or the problem isn't urgent enough. Oftentimes there will be a solution that comes along, good or bad, that interacts with this thing.
Well, but the CBDC is account-based, and so you must have an account to use the CBDC, and it's your unique individual account.
Oh, that's an assumption.
That is an
That's
assumption.
an assumption,
That is,
exactly.
that ties into his point about, you know, the implementation, the motivation, that all ties together. And so if the government really wants to have detailed spending records of every citizen or every person in that country, they can implement that to get that to happen.
But is the design of CBDC going to be planned, like the whole design going to be planned by the central authority, or is it going to be the market driven? Because, you know, I mean, it reflects the zeitgeist of people. People have, you know, they may have care, they may care privacy too much, so they may not use it at all. Like Korea, for example, we have this thing called coinless society. So we're trying to get rid of coins, but that has nothing to do with the privacy. It has to do with just inefficiency of holding coins, right? So, do you think the government or central bank will have a motivation, say like tracking or even surveillance on people's how people use cash, right? Do you think that's currently the central authority's motivation, or will that?
I don't think
adoption
you'll get a global consensus on that. I think you'll get very different answers based on which governments you're talking about. And we all know the ends of the spectrums, right?
And it reflects the concerns of that government, right? Because there are concerns, legitimate concerns about illegitimate uses of cash, right? For funding terrorism and for money laundering, tax evasion, and so on, right? Depending on your point of view, tax evasion may or may not be a good thing. So again, these things are based on policies and the philosophical bent of the politicians that have been oftentimes elected or chosen or somehow appointed in those particular countries that we're talking about.
Yeah, I mean that's a hard question. It depends on the situation and the political deliberations in a given country. I would this also from a personal point of view. I don't think any serious central bank wants to actually go and track people's activities. That's certainly.
Why though? Like, I mean, there are a lot of benefits about terrorists, anti-terrorists. You know.
Because institutions have better ways to doing that at the central
I mean,
bank.
do they care about the human? Like, do they think that privacy is a human right? So is it more like a philosophical reason, or
Jeff, can you separate the central bank and the role of the central bank from the other parts of the government who
Yes,
have different
yes,
jobs? Because
yes,
central
yes,
banks,
right.
when you ask a central banker, are you part of the government or are you independent? They're going to say,
Independent.
of course they're going to say
Yeah.
independent.
Sure,
But if
Yeah.
you ask different questions, then they'll say,
Okay. I won't ask any like policy questions.
so, but do separate them in your head,
Yeah.
because what central bankers want to do sometimes differs from what other parts of the government want to do. And that's common for a lot of different government departments,
Yeah.
right?
Right.
So in some of our research we put out last year, we were describing different schemes which the central bank could approach to issue e-money, so a general term for CBDC. One was the account-based system, in which you need to know a lot about your customers. That might not be too hard, you know, like most countries will have a national registry through passports or driver's license, so this is not too hard. But the question comes is like, does the central bank want to get involved in that and having to take care of clients and have all those relationships? And in that research paper, we have the opinion that it's not the comparative advantage of a central bank to deal with the public. Right now, we only deal with big institutions, and that would be a really big paradigm shift if the central bank were to get involved with individuals. So then this brings you to a scheme in which there are tokens. Yeah, there's anonymity, but you could still have a scheme in which there's delegation of tokens, in which the central bank issues kind of a core token, then it gets distributed by other intermediaries, which they could do the function of custodianship, AML, KYC, and then the system will actually look very similar to the system we have today, just with a new form of money.
Right, which then comes back to the, I think, say, IBM's point of view is that one of the things that could happen in such a delegated system is that the central bank effectively acts as a fungibility provider in taking the coins that are issued by different commercial banks that are responsible for the KYC, AML, and so on, of provisioning wallets for people, and then allowing them to be exchanged one for one. The thing is, they're not exactly the same thing. They're non-fungible in essence, but you are pretending that they are, and the central bank's role might be that, right, as that central provider of fungibility.
Isn't that that's what it does anyway? That's its role today with the real-time interbank payment system.
Exactly, but it does so in a credit-sensitive way sometimes.
Yeah, I guess there's a nuance difference between a delegated scheme in which you have custodianship, in which each token has to be backed. Each token issued by the commercial bank has to be backed by a token issued by the central bank. That's pure custodianship. Another delegated scheme in which there's intermediation, in which you might allow these commercial banks to issue fractional tokens, right? And then in that sense, we're back to the traditional system of interbank payments, yeah.
So just to follow up on another topic you had picked up, which was adoption, right? Bitcoin isn't being used a lot for point of sale at all. And I think people sometimes treat central bank digital currencies as if this is the first time that central banks have thought about issuing an electronic version or non-physical version of money, which isn't true. I guess an old literature talking about e-monies. But the question of adoption is actually a very serious one, which is why would consumers use this? Because Bank of Ecuador tried, what was in 2015, to issue an e-money, and they had to roll back that experiment because nobody was using it, because the government didn't seem credible either. So I think adoption is something that we don't talk about a lot, but why would consumers want, or the retail sector want to adopt the CBDCs?
And they assume you build it, they'll come, right? But then
exactly.
the commercial sector is very good at incentivizing people to use their stuff. They're good at shilling their own products.
So why should I use a token-based system as opposed to my credit card?
Right, so if I spend $1 on a central bank system and get nothing, no points, but I put it on a credit card and I get loads of air miles and points and whatever stuff, whether I use it or not, then like people like points. So like, what's the incentive mechanism? How can you beat what's being put out there by the private sector?
Which then loops back to the beginning when we were discussing accessibility, right? So in the United States or in highly developed economies that have these very robust, interlinked, remote payable financial systems, it might not be a big deal. It might not be feasible or smart to do. But in other countries where that doesn't exist, there might be a market for it.
Right. So I think that touches upon one of the areas of research that we're working the most on is what would be the implications for the financial system. And the key question there is, would a CBDC be a complement or a substitute to bank deposits? And generally our thinking is that by providing an outside option to customers, outside option to commercial deposits, banks would actually offer better rates to savers. And if they offer a better rate to savers, the total amount of deposits in the system would increase. So instead of substituting deposits, it would actually be a complement to deposits.
But doesn't that also imply higher rates to lenders, to borrowers?
That depends on how you think about the interaction between each side of the balance sheet of a bank. But I was just referring to the deposit side, so to the liabilities. So in an environment in which banks in the deposit side are oligopolistic, then you have an amount of deposits which are lower than the optimal. Yeah. So if you provide a competitive option to customers, there's going to be more deposits. Now with a larger balance sheet, maybe banks may be able to lend more But who knows? That depends on the models and lots of details, which we haven't worked everything through. But this is part of what we're looking at as.
Yeah,
as
but we also have to be careful that banks lending more is not universally a good, right? That can be distortions as a result of that, and we continue living in that.
Yeah,
something
I'm not putting a good or bad label on either. I'm just saying the result is ambiguous so far from our vantage point. And it all depends on the design again. We would have to be very careful in terms of if this CBDC were to pay interest, then setting that interest would be crucial to the outcome of being complement or substitute to bank deposits.
So effectively, you're setting the lower bound on interest rates in the market, right?
Exactly.
Which you implicitly do anyway because you have government bonds that do that. I mean,
But
outside of the
but you
central
cannot
bank
buy government bonds at a retail level. So
not in Canada, but in Singapore you can.
I've done it.
The Singapore savings bond.
But is it a means of payment? Can you pay with government bonds in a shop? You can't.
believe so, no.
So
It's a different instrument. It's
that's
an
why
investment. It's an asset rather than a means of payment.
Correct. So in this case, indeed, that CBDC rate would actually put a lower floor on deposits, and then links back to the question of adoption. Maybe nobody adopts CBDC because banks respond by providing kind of perks to respond with higher rates and miles and other kind of convenience features to the deposits. And people say, well, I'm not going to hold CBDC because it's not as convenient.
Until things go wrong with the banking, until there's a perceived shock or threat to the banking system, and everyone wants to
Potentially,
withdraw, convert
Right,
into something safer.
But then you're going to a safe haven within the country that's still within somewhat of the banking sector, right? Which
Or bitcoins.
Or Bitcoin.
Yeah.
Shit it. Yeah.
And then that's one of the third implications
Always.
on the financial system, which we're looking at, which is would it make bank runs more virulent? Would it make the financial system more prone to bank runs or not? And then
Have you landed anywhere with that? Because we've been talking about this for years. Would a digital CBDC, would a CBDC make it more prone or not? And some people say, well, you can put in the same speed bumps as you would with an ATM, like you can run out of CBDC, and sorry guys, you can say only $200 a day or whatever per customer. There's all sorts of things you can do to prevent that shock, I guess.
right. Well, that's the promise of CBDC, that is programmable money, right? So my hope.
No, that'll be a function of the bank just allowing its customers to convert or not. That's
It's
not
a
really
policy decision that can be
I think
implemented
so.
in code. So I think it's a big maybe, right? So until we have a functioning CBDC out there, until we have at least several of these running for a few years, it's very hard for us
with a
to
few
keep
shots
saying
thrown
that,
in,
right?
and
You have to really look at it, because I think some of these things are just plain unknowns. We don't know where to look. We can hypothesize, we can model it, but because inherent to the modeling activity is putting our assumptions in, and that's always based on things
So
we
who should
think
go
we know
first?
about.
Who should put their financial system on the line first so that other people can watch and learn? Gina, who do you reckon is going to go first?
Oh, I'm not answering that question.
All right, so I want to talk about something that is more relevant to the audience, because it's a crypto conference. Come on, we're going to talk about cryptocurrency. So I want to talk about stablecoin in perspective of central bank. So I think Bitcoin proposed a very elegant solution. If you think about Bitcoin, it's actually pseudonymous system. It's not anonymous system. Actually, you can track it down and find terrorists or drug dealers. The reason why, all these drugstores except Bitcoin or Silk Road got shut down is because of that pseudonymous trackable system. It's open ledger, right? So if we care about privacy of individuals, right? But we also have to care about the accountability of the bad act of using that private coins. Then can we actually issue a stable coin from the central bank in a way that we issue like JP Morgan coin or USDC?
But that's what we're talking about. CBDC is a stable coin, unless you mean
Yes,
the
but-
medium of record is on some public or private blockchain
Yes,
as a token.
Yes, on top of Ethereum or Bitcoin or any public blockchain. Can we actually do that in a pseudonymous?
So I would imagine that putting it on top of a anarchic public chain where you have no control over who's mining it, and you may end up paying mining fees to countries which may be sanctioned, is probably out of the question. So it needs to be some sort of private controlled, permissioned ledger like Corda.
But why is that? Why is that an assumption that that's not possible?
I actually would say that there is a whole continuum. So it's about the delegation, right? Back to Francisco's point that there are multiple models to do this, and it's really up to the risk appetite and the policy preferences of the government in terms of what they do. So it could be that you're looking at a use case for cross-border remittances, then a stable coin that is issued by a central bank or a set of central banks, something like a basket of currencies that are composed again of that master coin that the central bank issues, could be something that is plausibly of high utility, right? And could run on a public exchange. But the same, because with that, the same governance issues arise, right? That you still have, frankly, intergovernment relations are guided by international law, which are a complex set of treaties and traditions and customs, right? And those could be, we could encode that partly in what a blockchain does. And it doesn't necessarily have to be a private permission one that does that, because these are inherently supranational concerns.
Yeah.
But you want to control who can record, who can kind of mine, who can do things, no? Unless no one's going to take the risk to allow someone in a sanctioned country to record a bunch of transactions on.
Well, you might allow someone to record transactions, but it doesn't necessarily mean that the transactions have to be honored in the off-chain world. So I think part of the question here is how far is the influence of that blockchain, right? Ultimately, it's a transactional system for financial balances to be moved around. It's not going to affect the real world unless we allow it to, unless there are legal agreements that bind that in a.
Well, what's the point then? If it's not going to be, if the medium of record isn't going to be the medium of record, why bother?
If it doesn't have to be honored, why would I use it? Yeah.
Exactly. Or you
but
talking like
today,
lightning?
So that's a question that you can pose to today's banking system too, right? It is a system of record for financial balances, but it doesn't necessarily always have to accord with the legal view of the world. That's why we have courts that come back and say, no, reverse that transaction and so on. There's complex things about reality that we work in, where it's not just a blockchain or a financial system. We have to think about the legal system, about the political system, and all the rest of the stuff that Francisco started us with. Right?
Sure. I guess if you think about which technology underlying a CBDC we would use, well, again, it depends on what the use case is. Some of you might have heard of the Project Jasper. In that first phase of Project Jasper, we actually tried to implement our large value payment system in the Ethereum network, and we realized, well, this is not very efficient. And then, well, why? Because there's not enough privacy between banks. So we started kind of progressing and understanding that probably a distributed consensus mechanism in a system like this might not make much sense. Why? Well, the issuer is a trusted entity. Why would you have to distribute the verification when you already have a trusted central party?
But that's when you have one currency, right? So if you have two national currencies, then it might make sense to do something like what we are attempting to do with IBM Worldwire or some other basket-type systems where you have to have distributed consensus, because inherent to the political arrangement that backs this token is that, right? That you have a negotiated thing between two entities.
Right.
And back to the use cases, we've been looking at retail, like having tokens to buy coffee with in the shops adds a lot of complication, private key management and all of that, and what happens if I lose my keys and things like that. Where we found a lot more utility value, like usefulness, is for corporates. So corporates, when they transact, they're transacting a lot more digital to digital. So I am buying some financial instrument from a bank or from another corporate, and then you can have these atomic transactions where you've got a token representing money issued by a central bank or a commercial bank or whoever. You've got a token representing some other financial instrument, whether that's an investment or whether that's a bond or debt or whatever it is, or derivative, and then you can create single transactions which, I pay for it at the same time as I'm receiving it, which could dramatically lower the headache of the kind of reconciliation and having to track what money's doing what. So that's really, really interesting to the corporates that we speak to at R3.
Mm-hmm.